Right, good afternoon, everyone. The time is 12:30, so we will kick things off. I can see a number of you are still joining, so I'll go through some housekeeping and a very quick introduction before handing over very shortly to Ed Buttery. So obviously delighted to be here today for the final week of our Ideas for Your ISA virtual presentations. I'm here virtually, of course, with Ed Buttery, the founder and CEO of Taylor Maritime Investments. The clue is somewhat in the name, but just by way of a bit of housekeeping, we expect the presentation to run for approximately 30 minutes. Ed will provide some colour on the trust itself, a broader overview of the shipping market, importantly some comment on outlook, and some discussion around how they generate their income and potential for capital growth. Just from, again, on the housekeeping point, you'll note a Q&A function in the bottom right-hand corner of WebEx. Please do submit your questions throughout, and we will cover them off in a Q&A session at the end of the presentation. We expect that to last for about 15 minutes, so in total you'll be with us for approximately 45 minutes, and hopefully a very, very good use of your time. Participant lines will be muted, so again, to reiterate, any questions, please use the Q&A function. I think that's it from me, so I will hand over to Ed to run you through the slides. Thank you all.
Thanks, Hugo, very much. Welcome, everybody. Thanks for dialing in. So we're here today to talk about Taylor Maritime Investments. On a general note, shipping accounts for 90% of global trade. It remains the most cost-effective and lowest carbon intensity method of transporting massive volumes of commodities around the world, given the distances that need to be covered. Despite that, the industry is committed to zero carbon emissions by 2050. Taylor Maritime is doing everything it can in the meantime to slow down ships, reduce carbon footprint, improve emissions, and offset our carbon footprint as well. TMI is a unique vehicle to access the potential of the dry bulk shipping markets, the outlook for which is very strong in the next 2 to 3 years, potentially beyond that, but we have good visibility over the next 2 years, and that's why we're here today to see if we can garner some interest in our stock. If you look on this front page here, you'll see this is a typical geared bulk carrier. It has its own cranes, it's got log stanchions down the sides. What makes the fleet that TMI has special is that we have shallow drafts. We have a full fleet of Japanese vessels, which tend to be more reliable and are more attractive to our customers and end users. They can self-load and discharge, which means they can call a higher variety of ports, and their shallow draft means they can also call ports where port infrastructure is not quite as developed as some of the major ports that you will have heard of around the world. So we have diversification through access to ports as well as a multitude of different cargoes. That sets us aside from a lot of our other shipping listed counterparts in New York. And this segment also is defined by relatively stable earnings relative to the rest of the dry bulk market with the larger ships. We also carry necessity goods. That's to say we carry predominantly food or products that come from farms or fertilizer that goes to farms. But where we get the punch in rates is also through steel trading and global manufacturing. We don't carry containers. This is all bulk cargo in 5 different holds and hatches in the ship, a big giant floating wheelbarrow, if you will. Let's turn to the third slide, please. Or am I doing the slides? Maybe I'm doing the slides. Hold on. No, I'm doing them. There we go. Right, so we're an owner of high quality geared dry bulk vessels. We've got a combined market value of just under $1 billion. And that includes the acquisition we've recently made. And we have a very highly experienced team of managers across both our companies, TMI and Grindrod. We'll come on to Grindrod. Grindrod we own 83% of and is listed on the NASDAQ. We're structured as an internally managed Guernsey investment vehicle on the premium segment of the London Stock Exchange. We launched in May 2021 with a follow-on fundraise in July, both of them oversubscribed, and that allowed us to invest into the dry bulk segment right at the bottom of the market. we completed at the end of last year a transformational acquisition, securing 83% of Grindrod Shipping Holdings, listed in NASDAQ. It was spun out of a South African conglomerate, Grindrod Limited. And we're targeting 10 to 12% shareholder returns, and our dividend policy is 8% paid quarterly per annum. So we've just hit 2 million deadweight of ships with our acquisition, and we're now one of the leading owners of Handysize and Ultramax assets in the world. These ships really are the workhorses of the sea, and as I said, they're differentiated by the fact they've got their own cranes and they're shallow and can access a wide variety of ports and can carry a diversified range of cargoes, which again translates into smoother earnings and more visibility. In terms of our track record and our shareholder returns, we had a successful oversubscribed IPO in May 21, a successful oversubscribed $75 million raise in July 21, and we returned in our first financial year 45.5% on the share price, and we returned 81.3% on NAV in the first year, with a profit before tax of $253 million. We completed a sale at the end of last year, 25% IRR. We completed 2 further sales after that with an average IRR of 52%. And of course, our strategy now is to start deleveraging, exit some of our older ships, and we are on track, we think, to achieve those in time. We'll come on to that a bit later. We've outperformed the index in the last 2 quarters. We generated alpha of $13.5 million. The index dropped 34% in the second half of last year, and due to our chartering strategy, our average earnings decreased by 9% only. So again, our chartering strategy is smoothing out those earnings and allowing us to create visibility in the 8% dividend that we have told shareholders we want to achieve. We've got 4 times interim dividend cover with operating profit of just under $30 million a year. And we have a break even of just under $12,000 a day at the moment. That includes all our debt repayments, and our average earnings across the fleet are about $16,000 a day. And given the market has doubled since February, we expect that number to continue to be healthy, if not healthier, in the foreseeable future. So in terms of scale and growth, Grindrod contributed $352 million to our NAV. We hold that investment at fair value. The combined fleet is just under $1 billion of NAV. And we do have 1 new building coming in Q1 24. There are no slots available in Japan for new building deliveries until early or halfway through 2026. We managed to secure this contract because of our strong relationships with yards in Japan and my family's historical relationships with them. We have a limited strategy for fleet renewals. We don't think it's the right time to be ordering lots of new buildings. We definitely don't think it's the right time to be loading up on leverage. In fact, quite the opposite. So in terms of what the fleet's doing at the moment, we put a big trade on. We've got limited debt at the moment, which should be decreasing in the coming months. So just to summarize everything, our average yield at the moment is 22%. Our average time charter rate is just under $16,000 a day. Historically speaking, that's above the long-term average. We managed to smooth our earnings through a dynamic chartering strategy where we never have more than 1 ship coming open at the same time. We always are very invested in researching seasonal fluctuations, crop supply fluctuations, and so far our research has translated into outperforming the index and obviously returning good yields to our investors above and beyond the index. We've got 9% of the fleet locked in at an average rate of $16,800 a day versus the current index of 12,600. So again, like at the peak of last year, we managed to lock in quite a lot of ships on 1- and 2-year charters. We kept an element of the fleet open That's to say, a large portion of the fleet is coming open this year, and that was deliberately so because we expected China to be coming out of COVID lockdown. We expect manufacturing to come back. We expected stimulus plans in China. That all looks like it is coming now. But on top of that, we wanted to keep some ships open for sale in order to deleverage our acquisition facility that we used to acquire Grindrod. Talking about Grindrod Shipping, so TMI gained $352 million of NAV versus $339 million, including deal costs. So we managed to secure NAV of $352 million at a discount right at the bottom of the market. It really dipped December, January. And now, as I've said earlier, the market's doubled in terms of its rates. Sale prices are much higher than last done. And we're seeing a huge amount of demand in terms of acquisitions. And we've put on a trade where we've secured 16 very high quality, very young, desirable Ultramax vessels, which are the larger of the geared ships, and also a fleet of handy-sized vessels, which complements the existing TMI fleet. Excuse me. So we increased our earnings power by $632 million worth of ships without having to raise any additional cash from shareholders. So we've almost doubled our earnings capacity, and we took on $140 million of acquisition finance in order to do that only. The combined fleet, as I said, is nearly 2 million deadweight or tons of carrying capacity, I should say, and with an average age of just under 10 years. We've managed to also reduce our average fleet age. It enhances our ESG credentials. We're now able to sell some of the older, less efficient ships and focus on some of the younger, more modern ships that have stronger commercial leverage in the market. And of course, the two companies will start to work together as a combined fleet in order to increase earnings capacity, economies of scale through purchasing of spare parts, lube oils, fuel oil, and of course, we can spread the skill sets across both companies, which again should translate into savings on SG&A, parts supply, and earnings power. Our leverage at TMI has increased temporarily. We, generally speaking, have a highly conservative approach to leverage. Our debt to gross assets at TMI at the moment are 31%. We're targeting that to be below 25% by June. We're on track to do that. That requires about $53 million of debt reduction between now and June. That doesn't include the proceeds we received from our vessel on which we claimed a constructive total loss with our insurers, which was stuck in Ukraine for a year. So that $53 million figure is actually quite a bit lower than that to hit that 25% ratio by the end of June. So we're on track to do that. And of course, the longer term strategy is to have net zero debt. I've worked in shipping banks before. I've seen debt ruin companies. I've learned not to over leverage, to use debt as a luxury rather than a necessity. And that's very much what TMI appears to be achieving at the moment, especially in this high interest rate environment, and will continue to achieve in the coming months through asset sales and increased earnings. As I said, we've got 4 times dividend coverage. So when I say increased earnings for deleveraging, that's beyond the 8% that we have coverage for. So since TMI bought Grindrod, we've made changes to the board. I think we've got one of the best boards in shipping at the moment. Highly experienced people, very trustworthy, absolutely commercial, disciplined, and I'm really pleased to say that they're doing a fantastic job. I joined the board. I have also become, or will become early April, the CEO of Grindrod as well as TMI. This allows obviously a small saving in terms of C-suite roles, but also it means that we can have a clear strategy to integrate the management of the fleets and create those economies of scales that I was talking about. We've also inherited a highly skilled team from Grindrod, who under my leadership will be more than capable, I believe, of delivering on TMI and Grindrod's combined strategy in terms of chartering. My role at Grindrod will be mostly strategic in nature, but I'm going to be supported by a highly experienced team of managers a lot of experience, and they're more than capable of running the day-to-day. Grindrod's performance has been constantly and consistently to outperform the index as well. So they're a highly skilled team, and I'm really pleased to have them on board. In terms of the outlook of the market, from a demand point of view, there were some macroeconomic headwinds last year. 2022 was a weaker than expected year in terms of demand for major bulks and some minor bulks. As a result, there was a bit of a balance between supply and demand, which you can see has now started to change. So in the bottom right-hand corner of this, you can see in 2023, we're expecting demand to be about 1.3% and supply to be 0.5%. And that widens to about 4.2% throughout to the end of 2024. So there's a very significant shortage of ships coming between now and the end of 2024. But on top of that, we can expect that to potentially get better on the basis that the fleet is now slowing down, and that takes supply out of the market. The fleet is slowing down to reduce its carbon emissions. 9% of the handy-size fleet is over 25, 26 years old and is at scrapping age. So we can expect that to help. And the way the demand-supply curve or the utilization curve appears on a graph, for those that don't know, it's like a hockey stick. And once you get to sort of 88, 89% utilization, there's a sudden burst in rates, historically speaking, and they accelerate dramatically. We now think, according to our research with banks and broking companies, that utilization is about 87, 88%. So we feel we're right on the cusp of seeing a dramatic increase in rates, potentially. And if it's not dramatic, we expect it to be sustained and slowly firming over the next 2 years as this supply-demand spread widens. Now, in terms of supply, you could always ask the question, well, why can't people just go out and order lots of ships and destroy the supply side situation? The reality is shipyards, because of the container boom and the tanker boom, shipyards in Japan are predominantly full for the next 2.5 years. So as I said earlier, if you wanted to go and order one handy in Japan, the earliest slot you get is probably halfway through 2026. If you're very well connected, the very end of 2025, but you'll probably only get 1 or 2 slots. So we're talking about a shortage of ships in the hundreds of ships. And if you wanted to go and order hundreds of ships, you simply wouldn't be able to do it in the next 4 or 5 years in Japan. And if you wanted to go to China, you probably could do it in 26, 27, 28. But you're talking about a massive investment at yards that don't really want to build handy sizes. The margins aren't very good on them. The quality is okay in handies. It's not very good, not compared to Japan. We wouldn't be ordering ships in China, and we are one of the preeminent owners of handy size vessels in the world now. So China is focused on tankers and large bulkers. Korea really only builds gas ships and large container ships. And at the moment, Japan is full with tanker orders and container orders. Those container orders cannot be converted into bulkers. The whole design, the whole structure is completely different. So let's go on to the next page here. So in terms of China, China accounts for about half of global dry bulk trade. Its reopening is significant for us. It's a very important part of the demand side of our business. Coming out of zero COVID policy, when it last happened, saw a resurgence in rates as well as values. And we are expecting to see that again. In fact, we're starting to see the early signs of that now. Chinese New Year fell 2 weeks earlier than the last 15 years. And that contributed to especially soft rates in January, soon after Western New Year. But normally, post-Chinese New Year, you expect to see a recovery in rates. And this year, we've seen a 50% recovery in rates in just 1 month. And we haven't even started to see the effect of the supply shortage of ships that will materialize in the next 12 to 24 months. But we do have some optimism about China and its GDP. Now, admittedly, 5% is the target. And historically, they haven't always achieved it. But a lot of economists and banks have a consensus that they will achieve 5% or more this year versus 3% last year. We don't actually need a China boom for rates to significantly improve. What we need is simply for the supply side to be short. And as you can see in the previous slide, it's very short. And that's why we felt putting an investment into Grindrod and holding on to some of our ships was the right thing to do, and slowly deleverage as the market recovers, which is what we are doing. Grain exports are expected to increase in 2023, greater ton miles generated by diverted trades from the Black Sea. You've got Canada set to export almost double its previous season's exports. You've got Brazil's soybean season forecast at a record high by the International Grains Council, and Clarkson's monthly global seaborne grain trade indicator was up 6% year on year, which is a really strong start to the year. Most of the grain season haven't really kicked off yet or gone into full flow, so I would expect there to be some further improvement in rates from where they are today, even despite the fact that TMI is yielding its 20% plus. In terms of energy security, there is going to be increased coal demand, but TMI always targets zero coal. Our handy-size fleet, I think, carried 2 or 3% coal last year, and we're always pushing to carry zero on our handy-size fleet. And the loss of Russian coal imports and tightening gas supply in Europe, we expect to see an increase in demand for seaborne coal. So in terms of the fleet-wide impact of environmental regulations, on the 1st of January, regulations relating to carbon emissions came into effect, and that saw the fleet slow down quite a lot. Jefferies estimates that every half knot that the fleet reduces results in a 3.5% reduction in effective supply. Now, not the whole fleet will not be slowing down. The modern ships don't have to slow down as much. But where we think the slowdown is going to be most pronounced is actually in the handy-size segment, where you've got 9% of the fleet at over 25 years old and 16% over 20 years old. Those older ships need to slow down a bit more than the modern ships, and therefore will withdraw supply further from the fleet beyond the supply and demand picture that we've already presented to you. So that could surprise on the upside. We expect longer term increasing in scrapping as well. And that could also help just tick us over from that critical utilization point of 88, 89, 90, where rates suddenly hockey stick. Strategic priorities for us in the short term: we want to capitalize on the Grindrod transaction, capture the synergies through integrating the management, both technically, commercially, financially, create economies of scale in the business, share costs, combine purchasing power, combined negotiating power on our contracts. In the medium term, we're going to continue to have a strategic balance of short, medium, and long-term charters. This allows us to create some visibility of earnings, but it also allows us to leapfrog some of the weaker seasonal points of the year and keep an element of the fleet open for sale as and when opportunities arise to sell ships. If you want to sell ships and remain liquid, you've got to keep them on shorter charters. But also the discount you give away by having everything on long-term charters is too much to justify quite often. And at the moment, we see a balance of short, medium, long-term charters as the most optimal way of maximizing earnings. In the long term, we have a long-term deleveraging strategy. We want to create a balance sheet that's fit for the next 10, 20, 30 years. And our target, therefore, is always to be below 25%. But we always target zero net debt, and we hope to achieve that in the coming years, if not sooner. In summary, we're a significant owner in this niche segment of geared dry bulk carriers. We've got 57 ships. They carry necessity goods, so food. The demand, therefore, underlying is very strong and reliable. We have a strong cash flow. We have very high quality counterparts. The market fundamentals are very attractive. There's a very dramatic shortage of ships in the next 24 months, a very obvious lack of space at yards in order to upset that supply demand. And we do have a long-term and near-term commitment to reducing debts to below 25%, which we expect to achieve by middle of the summer. We're committed to ESG as we always have been, and it remains an important part of what we do. I think that's it, really, Hugo. I was speedy on that one, I think.
No, that's perfect, Ed. Brilliant. Thank you very much, and all very encouraging news on the transaction outlook, I think. So, got a number of questions that have come in, Ed. So I'll try and run through them in a vaguely sane order. So just taking a step back, I've just got an investor asking if you could provide a bit of commentary around the different categories of ships, why you focus on the ones you do, and perhaps some advantages and disadvantages of the other categories.
It depends what sort of risk appetite you have, but the larger ships in dry bulk are much more volatile. I'll give you an example. The Capesizers are the largest ships. They only carry iron ore and coal and are heavily dependent on China growing strongly. You'll have Capesize rates in a month. They could go from $100,000 a day to $5,000 a day, and the value of a new Capesize, a new building, could be $38 million in January, and by April it could be $60 million. It's massively volatile. The Capesize segment is for the big boys with big brave chests, not for us in the trust segment. My family has a lot of money invested in this vehicle and in this segment, and we're keen to run this the way we would want a public shipping company to run for our family office, which is long-term stable yields, potential for capital upside, strategic deleveraging, if not low or no leverage, and a focus on high quality diversified counterparts. So this is really, we carry necessity goods, so we effectively carry food, stable demand. The larger ships like the Capes, the Panamaxes, in a very bad market, they will earn zero. You'll have to lay them up, and you could sit there for 6 months in layup and not have any business at all. In the last 20, 30 years, there's never been a laid up handysize as a result of a poor market. It might sit in wait for a few days, but you don't lay up handies, which is why the average scrapping age of a handy is as high as 26, 27, 28 years old, because they do get used for the entirety of their lives. And because they call so many different ports, they will always have to burn a form of bunker fuel. Whereas a Capesize might go from A to B its whole life, and you could invest in ammonia or hydrogen or whatever it might be, LNG infrastructure, because you know where it's going to be and it's always going to large ports. These guys go to much smaller, more diversified ports where it would take decades to improve and invest in and upgrade the infrastructure to create an ammonia fueled fleet. So this is the segment of shipping which is going to be least affected by regulations requiring ships to burn cleaner fuels. But the reality is we expect this segment to go to e-biofuels, that's to say methanol of sorts, but we're still miles away from having that technology being ready for this segment of ships. And the governments cannot simply say, right, those ships have to stop, they're too polluting, because we carry food, and there would be political outrage and mass unrest if our ships stopped, because the world would stop eating. So we're most protected from new environmental regulations for the long haul. And we have a solid supply demand for our ships. I hope that's useful.
Very, very helpful, Ed. Very helpful. And I guess sort of on a similar point, I've got an investor sort of asking around cyclicality, obviously positing that shipping is a notoriously cyclical industry. How do you go about managing that cyclicality? I think you've talked about it slightly in your previous answer, but if you could elaborate on that point, that would be very helpful.
Yeah. There is, so you have the small cycles you have throughout the year. We get around that by having a very large fleet and having ships coming open throughout the year, which smooths your yield curve. In terms of the larger cycle, it's important that we know everything that's going on at the shipyards and we're able to exit our investments in a rising or at the top of the market. We're not defined by wanting to have the biggest fleet in the world. That's absolutely not the way we work. So in the event we think that the market is toppy or going to reach a top, you'll see us exiting a significant amount of vessels and returning that cash to shareholders. We will continue to run ships either way, even if the fleet size is significantly reduced. But the beauty of being a UK listco and an investment trust is that we're encouraged to diversify. And when you look at all of the major Greek shipping families, who are all very famous and have made billions and billions of dollars over the last 4 or 5 generations, the reason they've been able to do that is they've entered and exited the main segments across all shipping. So you've got your gas, you've got your product tankers, you've got your bulk, and you've got your containers. All the big shipping families have investments across all those segments, which has allowed them to maintain their team in place to run and manage the ships, but they can exit the bulk segment entirely at the top of the market, and they've still got these other segments that they can buy into. Now, if we were listed in the States, we'd be under a huge amount of pressure just to stick to bulk because the hedge funds want only bulk exposure or whatever it might be. I think in the trust market, and certainly as a family who have been in shipping for over 50 years, we are encouraged to look at the right type of assets at the right time in the cycle. So if bulk becomes expensive, we'll exit bulk. And if there happens to be an opportunity in containers or in low carbon footprint product tankers or in the gas space, then we could look to reinvest at some point in the next 5 to 10 years in those segments too, in order to create diversity. If we can't find other investments, we'll just return cash to shareholders. That's fine with us.
Understood. That's some very helpful commentary. And now, just taking a step back to sort of, I guess, outlook and the macro to an extent. Obviously, we hear a lot about deglobalization at the moment. It's a bit of an eminent theme. Would that have any meaningful effect, do you think, on the shipping market generally? Do you see opportunities? Do you see threats? What's the general consensus at the moment?
I'm not convinced. Look, people have been talking a bit about deglobalization, and governments have been talking about being sort of having food security and things like that. What's evident is most populations on most continents are far too big to be food self-sufficient. They have to import, and if they don't have to import the food, they have to import the fertilizer. They need to build things. Shipping is here to stay. It's not going anywhere. The population of China does appear to be shrinking over the next 10, 20 years. We've just made a significant investment in Grindrod Shipping, which is founded in Durban. The Grindrod conglomerate owns the port of Maputo, the railway from some of the mines to Maputo, among other things, a lot of infrastructure. So we now have a foothold in Africa. And the next 10 years, it appears that Africa is really where the growth is going to be in the demand for these ships. So it's a bit of a side note, because we actually bought the Grindrod fleet because it's a 104-year-old company, fantastic staff, probably the best fleet of geared Ultramaxes that exists. And we were able to put a trade on in one go in a market where these ships are simply not for sale, and we did it at a discount to NAV. But the side note here is we've also now got a foothold in Africa, and that's going to be very important for our growth strategy for the next 10 or 20 years. Africa's have container demand, product tanker demand, bulk demand, gas demand, and we now have a team of 48 people in Durban and connections with the wider logistics community in Africa to take advantage of that if the opportunity arises.
Perfect. That's really helpful. And just onto the trust itself, could you just provide a bit of comment on costs, charges, and fees and all of that?
Yeah, Camilla, do you have that in front? Is Camilla on? Camilla's probably a participant. Sorry.
So I'll take it offline with the investor. Absolutely fine. Let's move on to something that's hopefully a bit more broad.
We've just been doing a lot on this. My mind's a bit of a jumble, but we're very, very happy to publish these numbers. And Camilla's texted me. We can come back to them. We're literally going through the update. The target in terms of ongoing fund costs is 1.2%. I believe we're about there, if not slightly below. But obviously, what happens if you sort of sell ships and then that slightly changes but we're around 1.2%.
Perfect. And just on charter rates and perhaps just sort of to reiterate the dividend cover, I think is it fair to say you've got a reasonable portion of the portfolio with charter rates needing to be renewed fairly soon? You talked around your theory behind that. Can you just talk a little bit around the direction of travel for charter rates and the progress you've made on renewals this year, and how that may kind of impact dividend cover and the like?
Yeah. So rates were $7,000 or $8,000 a day in end of January, early Feb. They're now more than double that in many situations. Your 1 year rate on a 38,000 tonner today is probably $14,000 or $15,000 a day. your 1 year rate on an Ultramax is probably $18,500 to $19,500 a day. That's higher than what we were fixing ships at in the second half of last year. So we are seeing rates firm. We've seen them firm strongly. I think they're taking a bit of a breather right now, and then a whole bunch of new cargo will come into the market in the coming months, especially as Brazilian soybean season kicks off. So I'm not allowed to make financial projections and things like that, but the market is stronger every week at the moment. It accelerated in its strength between February and March. I would say that now it's firming. It's certainly firming, and we do have a lot of interest from our major charterers in taking ships on for 1 or 2 years, but it's still at a discount that we think isn't attractive yet. But at these levels, we're definitely comfortable saying that we've covered our dividend, and we're pretty comfortable about creating a bit of excess cash on top of that.
Perfect. I think we've pretty got time for 1 or 2 more. One that might be a bit challenging to answer, but I think it's fairly topical in any case. Just in terms of the Grindrod TMI deal, I've just got an investor asking if there's any way you can quantify any of the expected synergies.
Oh, that's a very dangerous one for me to talk about in terms of actual quantities. We've just renewed our insurance. That was a saving of hundreds and hundreds of thousands of dollars. I can't say exactly what, but just as an example, being able to go to your insurance broker and say we've now got 56, 70 ships or 60 ships rather than 26 makes a big difference when you're negotiating. The same thing will happen when it comes to purchasing lube oils. The same thing will happen when it comes to negotiating cargo contracts and charters. Quantifying it, I think I have to. I obviously have numbers in my head, and I know what we're probably going to achieve this year, but I'm not convinced I'm in a position to reveal those right now, because then I would wall cross everybody.
Yeah, probably a good shout. In that case, just to end, I've just got an investor asking about the shipping insurance industry. Actually, we talked a little bit around insurance. Is that an industry that remains in good health? Obviously, it's fairly opaque to us investment trust buyers, but any comment around that would be helpful.
Yeah, just quickly on that previous question, we are going to give more information on the sort of synergies at the next NAV update. But let's just say they are quite significant. It's millions of dollars, not hundreds of thousands. So it will make a big difference to the value of our shares and the profitability and cash generation of the businesses. In terms of the insurance industry, it's live and kicking. I think there were quite a lot of withdrawals from underwriters in the insurance business last year, especially as a result of the Ukraine-Russia war. On the whole, premiums are up about 6 or 7%. I think we managed to achieve a better result than that. Taylor Maritime has a relatively sound record, except for this obviously ship in Ukraine that got stuck in Mykolaiv. No, the insurance industry seems to be live and kicking. We have a very good broker that we use, Tysers in London, who do an excellent job. They're absolute experts at what they do, and they've managed to achieve savings for us versus our peers almost every year.
Brilliant. That's really helpful, Ed. I think we will probably call it a day there. We've covered a hell of a lot of ground and moved around between the market itself and the trust. Just a reminder from my side, I think the trust shares are currently trading on around about a 30 to 32% discount to the last reported NAV. Obviously, Ed alluded to the fact that there's an updated NAV soon to be published. I think it's fair to say that looks very, very cheap given what we've discussed in this session. Apologies to those investors that have asked a few questions that we haven't been able to answer. We'll come back to you on them offline. And I think with that, I will say a final thank you to Ed and a final thank you to everyone for joining. And just a final reminder that we do have 3 further sessions to round off this wider event. and we look forward to seeing a few of you on them, I'm sure. So thank you, Ed. Thank you for your time. And
No,
thank
it's
you.
my pleasure. I would say we have an open door policy. If any of you happen to be in Chelsea, please do come and knock on our door and have a cup of coffee, and we'll show you everything we know. Always welcome, even if you're not an investor but who are interested in shipping. Please do stop by.
Brilliant. Thank you, Ed. Thank you.
Right.
Have a good afternoon,
Thanks,
everyone.
guys.